Now we get to pick up with the U.S. and some of the key pieces that have come out recently. So one of the interesting ones is the MBA mortgage applications. Last month, they were down 3.2%. In December, they were down 10.3%. That's normal. Typically you have that big slowdown just because, people are home for the holidays. And you normally have that slowdown that continues in January and February, and then things start to pick back up in March. So nothing too crazy there. Obviously, it's a big drop. It should remain a problem as we see things going forward. But just because we don't see real estate getting any better, we do see it getting worse, and that's just a leading indicator. But we don't want to say, oh, look at that negative 10%. It's terrible. It's like, well, it's the holidays. Like how much are people actually looking around? So how much of this was seasonal? How much of it was beyond seasonal? And those are things that we're going to talk about as new data comes out throughout the rest of January. ISM manufacturing slightly worse than last month and below estimates at 48.4, still contracting. ISM prices paid well below expectations, coming in at 39.4, which is a positive when you consider inflationary drivers. So we want to look at that because in the first segment, we talked about commodity prices, low storage, and the stagflation side. This is the other side of it where some of the things are getting a bit cheaper. And again, we want to look at what's balancing that out. ISM employment last month was in November was 48.4 in contraction, expanded in December at 51.4. So we get the Fed minutes tomorrow for the December meeting. And one of the things that they're going to continue to talk about is employment. Employment continues to be very strong, and very strong is relative, because very strong versus everything it looks strong. It's not at 60, it's at 51, so it's expanding, not massively, but they're raising rates. And that should be slowing jobs, not increasing jobs. And that's, again, some of the problems and some of the concerns when you look at what they're trying to manage. Especially when you look at new orders, an important leading indicator. Last month it was at 47.2, in December was at 45.2, which is a slowing. So it went into further contraction in new orders is a key leading indicator for what the health of the economy is going to look like, what new orders are going to do, what activity is going to look like. And again, it's falling further into contraction. Now, following on the employment side, the JOLTS or the job openings was more than expected. So you continue to see this bifurcation where economic activity is slowing, new orders are dropping, manufacturing is contracting. All of these pieces are contracting, but employment is staying fairly strong. And a lot of that is driven by pricing, because we still don't have a lot of people back in the market. We still are well below normal on the people that are trying to find jobs. Some of them are just not going to work, and others have retired. And we've had charts in last year showing where things are going, what is happening in the world, especially in the US, where a lot of people retired and are not coming back. But we don't have that next leg of individuals, so you have to pay people and incentivize them to come back to work. So the job openings are coming up, but this is the floor of the stagflation side. So prices paid coming down, but employment coming up. Some of these pieces coming up and meeting it, keeping that a bit elevated. Now, here's another interesting piece, and we'll talk more about this tomorrow on the EIA show, but numbers of days worked on site per week, current versus preferred. So current hybrid schedule, people have to work either 1, 2, 3, or 4 days on site. Preferred hybrid schedule, as you can see, is 2 or 3 days. And that's what we've seen more of, is in terms of a lot of them are 2 or 3. And that's something that is becoming more and more common. Past, current, anticipated, and preferred employee work locations. Pre-pandemic, 8% wanted to be exclusively remote, now 34%. Hybrid, which is between above 10% and below 100% remote. But pre-pandemic, they wanted 32% wanted it, but now 60%. And that's something that I think is becoming more common, especially the hybrid schedule. And the reason why we bring this up is it's slowing down demand. And that's when you look at just what gasoline demand is doing going forward. We have cars that inherently on a normal replacement cycle are more fuel efficient, and people are driving 1 or 2 days less during the week. So that's where we continue to see some of these pressures on where those gasoline demand numbers are going to go. And then when you look at, well, who wants them? Because the pushback could be, well, this is what the employee wants, but what does the manager want? Well, when you look at it, managers prefer 2 to 3 days on a hybrid schedule. So you still get support on both sides of it in terms of where some of those different pieces lie. Hybrid workers will change jobs for flexibility, but won't give up salary, which again makes sense. But it just means that they want it. It's a perk, but they're not going to give up $5,000 a year to do it. Or, they're not even going to give up $5. So there's still a certain amount of threshold in terms of what people are willing to accept. Now, labor productivity, when you look at non-farm business sector, the productivity's gone up. Manufacturing has stayed fairly flat. And that's a bigger problem when you start looking at, well, how much of that is because people don't want to do those jobs? They want to be remote. They want to be hybrid. So non-farm business sector, again, that's something where there's more flexibility. People are a bit happier. And then manufacturing, that's where we see the biggest shortage of people willing to do the manufacturing component. And that's why we see prices going up, coming back to ISM manufacturing where employment's going up. But you're also seeing their prices going up because they have to incentivize people to come and work. US Manufacturing PMI, you get an idea of just how precipitous that drop has been. We think it levels off, something closer to, let's say, to 46, and then you start to see that bounce. Something similar what happened in Europe, where you're not going to continue to get worse. It's just going to find some comfortable point where you're still in contraction. It's not getting much worse, but it's also not getting much better, and you're going to see some of that growth again melt away. And here's some of the support for that. So when you look at leading indicators, average at start of recession is typically that yellow line. We're now well below it. Year over year percent change in the leading economic index down to negative 4.5% in November, which is firmly in recessionary territory. Then when you flip over and look at November's decline for leading indicators, marked the 9th consecutive monthly contraction. Going back to 1960, we've never seen that many months of continuous without the economy already being in a recession. So again, we're seeing more and more of these pieces that are showing that we're in a recession. The question is going to be, how bad is the recession? Is it something where we're down 1% and we're going to stay down 1% for multiple quarters? Is it something where we're down 0.5? One of the things that we've been saying is that the recession is going to be prolonged, but not that deep. And that's going to be the struggle, because there's going to be that kind of pivot back and forth, similar to the 70s, where you did get an extreme recession, but then you had a bounce. But when you average it out, things are a little bit different than the 70s. And that's why we like to say that history doesn't repeat itself, but it rhymes, because there's a lot of similarities, but there's also a lot of differences. There's differences in terms of work. Employment, because if you think of the 70s, you had a lot of new employees, you had a lot of jobs that were going abroad, so you had to, you had that working against you when you consider where are you going to get places employment. So unemployment was higher. You had jobs going overseas. You had unions that were pushing back and forth. We don't have that to the same degree. Instead, we actually have the opposite, where jobs are coming back into the States. You're getting a reshoring aspect. So there's some of this back and forth. It's just what is going to win out. And we see a recession as the likely outcome, just not to the depths that I think some expect. But now, as real estate starts to, I think, pick up steam to the downside, that's when you can start to see that acceleration to the downside. But that's going to still take time. And that's something that we have been talking about, and we're going to continue to highlight as we go forward. So then when you look at it a bit differently, when never before has the U.S. lead indicator been this low without a recession having already begun. And then when you fast forward to the Philly Fed state indexes, the number of states with negative growth, when you look at the average threshold for a recession, we've hit that mark. So when you look at the conference board, then you look at Philly Fed and you put them together, you're like, all right, well, we're already there. I don't think anybody would argue that we're there. The question is, what is the depth? What is the long-term ramifications? The 6-month rate of change of the leading economic index has a perfect track record of forecasting recessions. The leading indicators tell us that a recession is right here, right now. And then, so one of the things that we've talked about, Q1 is going to be tough. Q2 is going to be better than expected. And then we think Q3 and Q4 are going to be two very difficult quarters because there's going to be Q2, which is going to look pretty good, yet Q4, Q1 that were weak. People have to go out, they have to order, they have to get things. Q2 is going to surprise a bit to the upside. China is going to have fully reopened by that point. You're going to have some of this momentum, but then we think that really fades in that Q3 and Q4. Views on the first Fed rate cut are split, and as all of you know, I do not believe that they are cutting rates for the next 12 months. We do have some additional increases, so I think you're going to get more people that are going to say in the first half of 2024, and that is going to become a bit more of a common thread. Versus in Q3 of 2023, I just don't think it is likely at this point, given everything that we've talked about previously. U.S. government holds the debt burden, and again, as rates go up and as they stay higher, and as the government is forced to roll their debt because we have a deficit, we have to not only roll old debt but also issue new debt. That is only going to increase the pressure. And if you going back to 1945, essentially World War II, the government has the highest amount of debt on its sheets going back to that period. So now when you look at the 12-month forward and the Alpine macro estimates, you get an idea of why we see some of these movements coming down. We talked about it in the first slide, but it's just now that you've seen all of these different pieces, that's why we think that this could be more of a earnings recession to begin with, because Q4 was tough. That'll take things down. Q1's going to start out very slow, and that's going to, again, pull down those estimates and bring us on lower again. Construction spending surprised a bit to the upside. It was expected to be at negative 0.4, came in at 0.2, and a lot of that is built on non-residential. So you're starting to get some of that pivot where residential's slowing down, but again, slowing is relative. Going back to 2007, it's still the highest it's ever been. It's off the highs, but we are seeing non-residential pick up, and that's actually the highest it's been going back to 2007. So that works out to kind of help bridge some of that gap, which is a net positive when you look at the economy. And that's why when you look at recession, non-recession, it's not like everything is fully negative. We're going to be down 10% in GDP Q1. It's back and forth. And that's why when you look at this, there's a recession here. It's just not that deep. We do think it gets worse, but not yet. Then when you look at global manufacturing on the S&P side now, came in at 46.2. New orders came in at 42.7. So they're slightly different than ISM, but it gives you an idea that they're both moving in the same direction. New orders are down. Both agree on that. I think the ISM was at 44. They're at 42. So again, you're still seeing that pressure, that those leading indicators showing that pressure point. Then when you look at deposits at all commercial banks, you can see that we're at the lows that we haven't been at since I think that's 94. But look at the surge prior. And if you look going back to the 1970s all the way to today, there's only been several small periods where deposits were negative. And that's something where when you look at the huge surge that we got, it's going to take time to pull that out of the system. And then if you look at M2, taking that same period of 1995 for deposits and then M2, it never actually went negative. So we've been in a continuous inflationary cycle on an M2 basis, but at some point that liquidity has to come out. I'll talk more about this next time, but RRP, the reverse repo, there was a record amount that came into the RRP into year end. Now you had month end, quarter end, year end, which is why we did expect to see that surge. It happened, but that also shows you there's a lot of liquidity that's still out there. There's a lot of wood to chop when you look at why rates are going to stay elevated. Then when you look at durable goods, the survey was for -1, came in at -2.1. So this is a little bit different. And this is, again, on the other side where capital goods orders, non-defense aircraft, they were fairly flat. But real capital good orders, when you take away that inflationary side, you can see it's starting to roll over. And that is going to be a pressure point. And still hasn't gotten back to where we were. Well, it got above where we were pre-COVID. But you can see that from 2018 through 2019, we had that slowdown. And that is something that we do expect to see again as we head into the new year. Dallas Fed manufacturing was expected at -13.5, came in at -18.8. So again, coming down, more pressure there as we've been saying. Fed manufacturing CapEx expectations coming down, still expansionary, but moving in the wrong direction. Richmond Fed manufacturing was expected to be at -10, came in at +1. But you can see it's just bouncing back and forth. So we do expect to see that roll over again. Vendor lead times have gotten better, back to what we said in segment 1, where that is not the same issues that it was previously when you look at the overhangs, when you look at the problems that a lot of these companies were facing trying to source product. Then when you look at prices paid, slowing, but again, still elevated, still expanding. Prices received coming down, but just back to the lows, to the previous lows, but at a higher point. Because going back to 2005, we still have never been this high before. So yes, we're off the peak, but in comparison, we're still very elevated, which means that, again, there still is some of that inflationary component to where we sit right now. Richmond Fed manufacturing wages bounce back up. That is what we've been talking about. If some of these overhangs in terms of wages, they're bouncing up because you need to attract employment. And that is an inflationary side to some of these different pieces. Now, Chicago PMI survey was for 40, came in at 44.9. Still contracting, but again, you had a little bit of a bounce. The question is, where do we go from here? And that's where we see an additional rollover because we don't see January getting better. It'll likely get worse. And that's where we're just going to go sideways at this point. So even though Richmond Fed was positive by 1, all the others were negative. And you're seeing some of that continuation. And as we've been saying, the leading indicators, the key pieces to watch are showing that things are slowing, new orders, manufacturing. So again, that's going to bring us down, at least for how we ended in Q4. And then we do see additional slowdown in Q1 and most importantly in January. So that's what we have here on the manufacturing side, leading indicator side. Next segment, we want to look at the consumer and how are they shaping up at the beginning of 2023.